You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is Interview Tuesday once again here on the network. Time for Options Insider Radio, our interview program where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. Like the man said, my name is Mark Longo from the optionsinsider.com, as well as, of course, from the aforementioned network. Reminding you, if you like what you hear, it's not just interviews here on the network. Usually there's a couple of things hitting you a day throughout the week here, close to a dozen programs. If you want to get all that, make sure you subscribe to the full network wherever you're listening to this. And also keep rating and reviewing. It really does help. We've seen just an explosion of new participants, new entrants into the options market over the course of the past year, many of them beating a path to our door. We want to keep that flow going. We want to be the lighthouse to them in these stormy markets and stormy seas out there. So keep rating and reviewing. It really does help those new folks discover the content. And of course, keep those questions and comments coming. And we do love to hear from all of you guys and gals out there. And let's see who we're hearing from on the old program today. I am joined by Doug Engmann. He is the chairman and principal executive officer at SageTrader. Doug, welcome to the Options Insider Radio program.
Thank you, Mark.
And Doug, as we were wont to do with all of our first timers on the network, why don't you go ahead and give our audience an overview of your background in the options space, as well as what it is you folks do over there at SageTrader.
Well, Tom, I've been fortunate. I've been in the industry for almost 45 years. I hate to say that because that dates me a bit, but I started in 1977 as an options market maker on the floor of the Pacific Stock Exchange. And from there, co-founded a options market maker clearing firm, which was called Sage Clearing back in the 80s, and a retail options firm called Preferred Trade. And so I have experience as an entrepreneur in that business. And then we sold those businesses to two big banks, where I became global head of prime brokerage, securities, options, and futures. So I've had experience as an entrepreneur, a smaller firm in a big environment, and then a big player in the business as part of the banks. And over the years, I've got involved in policy. I was acting chairman of the Pacific Stock Exchange. I was on the board of the Options Clearing Corporation, National Securities Clearing Corporation, and helped pioneer a portfolio margin in 2005. So it's interesting as we see the market events of 2020 and 2021 to look at that with a historical eye and see what things are repeating themselves from 10, 15, 20 years ago, and then what things are new in the industry. At SageTrader was founded in 2012, and we have been doing introduced professional trading business up until 2020, and then we migrated into the execution business primarily over the last year. And it's been an interesting ride, and we've learned a lot even after being in the business for a long period of time. But like I said, right now we're primarily doing execution business. Our introduced business was primarily options. Our execution business is primarily equities right now.
Well, you mentioned it. Looking back at the options market these days with a historical perspective is certainly interesting. This past year, Doug, I'm sure stands out to you as it does to everyone else. You can't really throw enough adjectives out at it to describe the year that was 2020, and now so far already has been 2021. Unprecedented, insane. Throw them all out there. They all pretty much apply. Like you mentioned, you've been doing this options thing for a few years now. What are your thoughts just in general, looking back at the year that we saw already in 2020, the absurd levels of volume coming in, billions more contracts than the previous record year. And now, of course, that volume seems like it's staying the course here in 2021. For you, who's been around the space for a little bit, what are your thoughts on what we've witnessed over the course of the past year and now continuing into 2021?
Well, we were all worried, particularly after the 2000 market crisis, that the retail options trader was going to fade out of existence. And it's taken a while for the resurgence of that. I think part of that is due to education, a little bit more sophistication among some of the younger people who maybe have taken a derivatives course or a securities course in college. But it's more been because, quite honestly, the SEC and FINRA have been fairly lax on enforcing the regulations that we lived under for, 20, 30 years about who could open an options account, suitability, and trying to protect, right or wrong, trying to protect the retail customer from entering a business or trading product that wasn't suitable for them. And I think Robinhood, is a prime example of that. It was pretty easy to open an options account at Robinhood without, for example, all the due diligence that we would have to do at SageTrader for a professional trader who might be an ex-market maker who had to go through a risk interview and had to be qualified to trade particularly uncovered calls or uncovered puts. So I think it's been a change in regulation, and then of course the Reddit effect of having what I would call coordinated activity in particular stocks and particular options. I mean, the retail customer was really pretty active in 98, 99, 2000 in the tech run-up. And there were a lot of examples of GameStop type of activity, but it really wasn't coordinated. It was basically general hype in the market about certain internet stocks, and everyone wanted to be in. And now you have it a little bit different in the sense that social media has created what I would call crowd interest in particular issues, and that generates a certain higher level in the use of derivatives, particularly in the GameStop phenomena. So it's been lax regulation and social media that I think has helped increase the interest in derivative activity.
Interesting. You mentioned, kind of the lax regulation, lax oversight. It sounds like you're kind of a fan of what Robinhood is doing out there, which is interesting because I know a lot of people in the space have looked at Robinhood and maybe thought for a couple of different reasons, maybe they've made it almost too easy for people to get into options. The platform is very streamlined. A lot of people point to the gamification of the platform, prodding people to trade, maybe perhaps they shouldn't. It sounds like you take the other side of that coin, Doug. It sounds like you think that's been a good thing. And we certainly have seen from a volume perspective the results of these new brokers and indeed these new waves of entrants out there in the markets over the course of the past year, Doug.
If I sounded like I was a promoter of Robinhood, that's mistaken. I think Robinhood missed the opportunity to educate their customers because they had the tools to do that before they entered the options market. Yes, by pushing the envelope and promoting options, I think was really good to do, but they had to do it in I think in a more sensible way, so that people understood, what their risks and rewards were. That's my big issue with Robinhood. Is when you're a new entrant, you've got this kind of new interest. Brokers do have a responsibility to make sure their customers don't blow up. And I didn't really see that sense of responsibility at Robinhood. So while I think it was good that they were promoting the options business, but I think they need to do a better job educating the options customers about trading options and different ways of using options properly.
That certainly sounds like what I expected more from you, Doug, because you're right. It is a bit of a double-edged sword. They brought more people to the table, but of course we saw the tragic consequences of the lack of education that they're providing to their clients over there last year. They say they're doing and taking more steps to actively address that. I suppose we'll see. But I'm curious, you brought up something else, which is kind of an interesting topic here on the network these days, which as we've seen this explosion of new participants, call them whatever you want, the one-lots, the retail, the Robinhood traders out there. There's many more of them now than there were even a year ago in the markets, which has raised interesting concerns about something you brought up earlier about the approvals. You mentioned the approvals and the regulatory hurdles you have to jump through to get, let's say, an institutional client approved or even something basic like covered calls. It's gotten to the point now where it's pretty easy to sign up for an account at most of these brokers and even to get what used to be the gold standard, level 3 approval. That means you're pretty much approved to do just about everything out there in the options market. You click a few buttons on a form and you're pretty much good to go. You have level 3 clearance to hoist yourself on your own petard if you are so inclined out there. So I'm curious, some people have brought up the notion that maybe we need to revisit the level 1, 2, 3. Maybe it's not sufficient. Maybe we need different levels and maybe more levels. What are your thoughts on the current status of the account approval process? And maybe do we need to rethink it here in light of what we've seen in 2020 and now 2021?
No, I think the option approval levels that have been approved, yeah, they could always be improved upon. But the issue is, what do you have to show in order to be able to get to the different levels? And like I said, at SageTrader, we had, maybe 100 customers, and we were doing a huge amount of volume. But each one of those customers, I did a risk interview. And most of these customers were, like I said, ex-options traders. But the kinds of questions we would ask to demonstrate what kind of experience they have is, did they know what pin risk was, for example? If you've been in this business and trading options as long as I have, there are many ways that you can get nailed in the options market that you didn't even know about. Or if you had a box on and one side got exercised and now you had margin calls. I mean, those are all kind of hidden risks. And so what needs to be done is not necessarily change the options levels, but to strengthen the vetting and maybe putting in an automated program rather than doing verbal interviews, is asking people questions about not only their investment experience and an amount of money they have, which is really kind of what the FINRA SEC rules are, but getting into, do they understand how options work? And you put that in an automated program, have them answer the questions, and then you can judge how experienced that trader might be. And that'll be a much better way of screening out people who don't really understand how options trade versus people who are experienced enough to be able to do uncovered calls and puts.
Yeah, but Doug, then you can't just click a button on a form and be approved for level 3, Doug. And then how do you have the volume explosion if you can't just click a button?
No, you can. You're just clicking a few more buttons. Okay, you're asking for level 3, and then you get a questionnaire of 5 or 10 questions about how the options markets work, or how you make money or how you lose money. And if you fail that test, then you can't click through and get the options 3, but because you don't deserve it. It's the problem. The problem that we always had is if the retail customer got into the business and started to lose a lot of money, there'd be a big backlash, and the backlash would be more damaging to the option business than the spike that you have by making it too easy to trade options. And it's a fine balance for everyone to have in order to be able to make sure your business and your product survives. I mean, you just can't throw all the rules out to the thing and say, hey, we got great volume, and then find out that most of the customers are losing money, so they stop trading options. So it's a matter of qualification and education. You got to qualify them, and then you got to educate them. Or you got to educate them and then qualify them.
I would love to see something like that enacted, where if you click level 3, you want to get level 3, bam, a little quiz, a little questionnaire pops up. And if you can't even answer those basic questions, pin risk, whatever the case may be, then guess what? You don't get level 3. And I know brokers don't like to say no. It's not in their best interest at the end of the day. Or at least they don't think it is, because, of course, they want to get the volume. But, of course, like you mentioned, if the clients don't know what they're doing and they end up blowing out too soon or causing a needless risk for themselves or for the brokerage firm, that isn't a good thing either. Doug, you mentioned you've been involved in the business for many years. You were early there on the P Coast back in the day. I'm curious for you as well, looking back at last year, we saw another unprecedented event happen, something that back in my days on the SIBO and the market makers, they would always talk about this day was coming. This day was coming where, the floors would go away and the business would go entirely electronic. No one thought it would be a pandemic that would get us there, but that's exactly what happened about a year ago now. And we saw the entire business, even storied pit-based products like SPX, or even over there at CME like the Eurodollar, is all going electronic for the first time. And maybe it's the diehard cynic in me, but I expected there to be myriad outages, crashes, bad quotes, all sorts of just disasters that would really impact the volume in a negative way. And what we saw was actually exactly the opposite. There was uptime across the board. And not only did they survive in those environments, they seemed to thrive. The volume was off the charts. I'm curious for you, Doug. You've been around the space for a bit. Were you as surprised as I was last year that the markets not only survived the onslaught of volume, but actually thrived and did record levels of volume, and what was effectively an all-electronic environment for the first time?
I was not surprised. I was not surprised. The exchanges, again, having been involved with the Pacific for a long time before it sold to ARCA, I've been watching the exchanges. When I was on the OCC board, we were watching the exchanges, and they've been working for a long time in terms of improving their capability. And, I visited the New York Stock Exchange in, 98, 99, talking about how many orders that they would try and restrict people from sending. And we said, you can't do that. And they said, you know what? We agree. We're just going to have to build the capability. So I was not surprised that they were doing the kind of volume that they were doing. Plus there was the pandemic, helped create volume. The bigger issue was the newer entrants in the broker side weren't as ready for it. So you did have outages at different places. Robinhood was one of them. And that's where the issue came. And that's quite honestly where the rubber meets the road, because if you can't trade because your broker's down, it's a problem. If you can't trade at one of the options exchanges, unless you're trading one of the proprietary products, you can always go to another exchange. So the exchanges, I think, were well prepared. The brokers were not as well prepared for that kind of volume explosion.
It certainly seems to be the case. Speaking of the volume explosion, we talked about it, just how insane the year was last year. One of the big questions coming into this year was, will it continue? Will this volume explosion persist, or was it a flash in the pan? It was all pandemic related. People go back to work. It's over. It seems like so far this year we've seen it has persisted. March was the busiest in the history of the options business. January right behind it, number 2. February, I do believe, number 3 in there. So 1, 2, and 3 just in the first quarter of this year. So it seems like so far, at least, the volume has persisted. But I'm curious for you, Doug, looking back at the industry for a while now, do you think this is a flash in the pan? You think we'll be at north of 7 billion contracts again for the foreseeable future? Is this a sea change in the options industry, or is it kind of more of an aberrant blip and it'll go back to normal sometime soon?
Well, I don't know what normal is. I mean, when I was on the OCC board, if we were trading 1 million contracts a day, it was a lot. So the average has gone up, considerably, and but I don't think it's going to stay at this level for for an extended period of time. I think it'll drop a bit. A lot depends on the volatility in the markets. I mean, prior to 2020, if you looked at the option business in 2017, 2018, even 2019, it was increasing, but it wasn't something that, you were jumping with joy about because volatility was down. So I think it depends on volatility. And I think it depends upon how many of the new retail customers are actually making money or how many of them are not making any money and just decide to drop out. So there's still a lot of interest. The one good thing is, even if you're not in the business, you've read about the option business. And that's something that didn't exist, 10 years ago, where it was mainstream talk that, there were hearings that were being broadcast on CNBC. So we've created a crowd of people who could be interested in options that may come in, and that may provide a base for the amount of option activity that we have, because people may want to go in and start to try it. The big traders, the professional traders, the hedge funds, they require volatility and to make money. And so there's going to be a balance. It depends on the volatility, and it depends on the level of retail business based on the existing retail traders and any new retail traders that are going to come in.
Well, that's certainly true. We have seen penetration for options to a level I never certainly anticipated. And the nice thing is, it's not all negative. Usually when options are making headlines, it's all for terrible reasons. And there's been some other financial disaster like long-term capital or pick your poison that is being leveled at the option space. This is one of the few times where we're seeing options mostly being talked about in a positive light. You get your odd aberrant moments like the being blamed for accelerating the GameStop crisis and things like that. But outside of that, it generally has been mostly positive, which is refreshing for anyone who's been in the business for some time. You mentioned what it will take to keep these retail folks around a little bit, keep them from losing money. One of the things I've heard bandied about quite a bit these days is perhaps bringing back the mini options in some way, shape, or form. And you mentioned you were around for the last iteration. We all were, Doug. It doesn't seem like it was that long ago, but it was actually back in 2012, 2013 when the industry really first took a stab at this, back when Apple was threatening 700 and everyone was scared that would drive away the retail clients who were all trading Apple like they are today. They're still trading Apple. So they came up with the 1/10 size options. They listed them on Amazon and Apple, GLD, and a few others out there. And in spite of everyone in the industry loving it, they withered and died on the vine fairly quickly. I'm curious for you, Doug, do you think it's time for the industry to revisit that, maybe bring those back? And if so, what can we do to prevent a repeat of the disaster that happened last time?
I think the problem with the mini options is that the more differentiating product that you have confuses the customer. So, and I haven't, look, when you have retail customers paying $100 for an out of the money call that's 500 points out of the money, like it was in GameStop, I don't think the mini option will make much of a difference. Maybe you'd have more people who buying it at $10 a call. But it's just too confusing, I think, for the customer to figure out how to relate the mini option to what everybody else is trading. So that's just my gut feel. I think that's why it didn't succeed the first time around, and that's why I'm not sure it'll succeed this time around, because the business is at its high, and people don't seem to be bothering having to pay the dollars that they want to pay in order to be able to trade options. That's just my personal opinion.
Well, it doesn't seem to be alone. We just did a poll on it recently for our audience, and there was more in the negative category than I thought against the return of mini. I thought it would be a slam dunk. People would be diving back into the mini fray with great gusto, but apparently there are more people out there like you, Doug, who think maybe once was enough for the mini fray. And speaking of enough, Doug, we are running out of time here on our Options Insider Radio segment. We always like to leave our audience wanting more. So if there's a topic you think we should have squeezed into the show today you want to get at really quickly, or perhaps you want to leave our audience a little bit of a tease, a little bit of a hint of what's coming down the pike from you and the team over there at SageTrader, now is the time, sir. The floor is yours.
Well, I think that if you're trading options now, and you're part of the social media group or whatever, the interesting thing is the planned blow up in volatility and gamma. This is an entirely new phenomenon where people want to move a stock by buying options way over what the value might be, and therefore creating a huge gamma effect or negative gamma effect on the people who are selling the options. And that's a very dangerous game for anybody to be involved with, because the professionals that have the money are going to be out there selling those options, and they're going to be sophisticated, as opposed to the hedge funds who were short the stock in GameStop and just got caught in a huge short squeeze. So that's something that I think, people in the options industry have to be very aware of, and that's gamification of a particular stock in order to get it to go up. Like I say, it could be successful, and it was successful for one day in GameStop. But anybody who bought gamma in the out of the money options on that day got burned. Again, it's something that the audience needs to be familiar with, understand, and be very cautious about.
Since you touched on GameStop really quickly, I can't let you go without hitting on that as well, because you're right. I mentioned it was a very dangerous game, and all this interesting reverberations we've seen throughout all these other stocks out there. We've had many guests come on the network who've said, I never expected anything to hit a 400% implied vol, let alone 1,000 or insane levels that GameStop and some of these other meme stocks have hit. They also talked about how it's changed the way things like stress tests and risk factors have to work now. Whoever thought you need to stress test GameStop and AMC and a bunch of these other names together, but that's the world we're living in now. I'm curious for you, Doug. You've been around the space for a bit. What were your thoughts when you saw all this playing out? Now, you mentioned, the gamma impact driving things north, and also just the insane developments like 1,000+ implied volatility, call skew being bid up, way over put skew in an equity, and all these things that we were taught when we walked on the floor could never happen.
Well, it certainly was a surprise that it went up as much as it did. But the one thing I've learned about the options industry is you can never be totally hedged unless you don't have a position. There's always a way that you're going to be able to get burned. And it's sometimes a once in a lifetime, but in other cases, it's a very rare example of stocks burning you, where you have pretty much a bankrupt stock going up 1,000%, and you're short the 30-point out of the money calls, and you got blown out of the business. So it was a huge trading opportunity. I mean, most of the professionals made a lot of money in those 2 or 3 days. I don't know how you could not sell a $100 bid for an $800 GameStop call that expired in a week. Now, that's not to say GameStop couldn't have gone to 2,000. I mean, that's the problem. When you get into a short squeeze, you can get totally burned. But all I'm saying is the professionals, this is why I say people have to be cautious. Professionals all made a lot of money during those times. I don't know how the retail customer fared. You know, if you bought vol with GameStop at 80, you made a lot of money if you sold it at 370. For the people who bought it when they were 370, there's no way you made any money.
Yeah, that's the other side of that trade that people don't talk about, right? The all the way back down of that trade, and I left some wreckage in its wake. Well, Doug, I appreciate you taking this time to join us today. Take a little bit of a look back and indeed a look at what's going on now in the world of options. And before we go, if folks are interested, maybe they want to learn a little more about what you and the team are doing over there at SageTrader. Doug, where should they go? What should they do?
We are accommodating execution customers only. We don't really introduce customers. But www.SageTrader.com describes kind of what our business has been and gives some background on the principles that are involved.
There you go. Check it out for yourselves. And, of course, check out the rest of the content that's coming at you throughout the week. It's a lot more than just interviews here. We have Education Wednesday coming up tomorrow, going back to that theme we hit on many times today, the importance of education, Options Bootcamp, Options Playbook Radio. 2 great shows for that. Thursday, of course, This Week in Futures Options, and indeed episode 2 of the Option Block. Friday, Volatility Views, and Monday kicks off again with the Option Block and the Crypto Rundown, all the way through to another Interview Tuesday and another episode of Options Insider Radio.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.